Welcome, I'm Ernie Goss, McAllister Chair in Economics here at Creighton University in beautiful downtown Omaha, Nebraska. Here I'm on the first business day of February to report on the business conditions for the 9-state Mid-America region for the month of January. Now the 9 states, of course, as you know, stretches from North Dakota and Minnesota in the north to Oklahoma and Arkansas in the south, right down the midsection of the country. Dependent on agriculture, dependent on the energy, so those two industries, those two sectors have a large impact. And we produce, what I'll argue is a leading economic indicator. It's the canary in the coal mine. So what is that canary saying? What's the overall index? It's the highest level since February of 2015. That's good, of course. Now, economists, we tend to focus on the negative, but that's a very good number. As I said, highest since February 2015. The overall index expanded to 54.7. Now, the range from 0 to 100, so 54.7 is growth positive, 50 is growth neutral. Expanded from December's 53.1, so that index is moving up just like the national number. Here I'll bring up a chart showing you those numbers there, and as I always say, in beautiful Creighton blue there, you see it spiking up, moving up for the third straight month, but moving up to its highest level since February of 2015. There you see in red the national number. The national number will come out later on this morning. I didn't, of course, it'll be released about 9:30 Central Time, not out just yet, but it's moving upward. So the overall manufacturing economy, the overall regional economy, the U.S. economy is moving forward. The job index for the region, for the Mid-American region, is 57.0, even stronger, up from 50.9 for December. That's obviously good. Highest since August of 2014. So we're seeing some job additions in the manufacturing sector. Almost 1/3 of the businesses reported that finding and hiring qualified workers was an issue, and that still remains an issue. Another issue that gets underreported is inflation. Our inflation gauge was up to 74.2, up from 70.4, and its highest since April of 2014. So inflation at the wholesale level is ticking upward. That is problematic because the Fed will begin raising rates. So that's the real issue, and I think it's going to happen. I think it's going to happen in the first quarter of 2014. In fact, when we have a rate hike, about 1/5 expect negative fallout from a Q1 rate hike. Now, of course, that means 4/5 expect no impact or even a positive impact. Not that many a positive impact. Most think not much of an impact from a rate hike in Q1. So we are seeing that. But that's the overall report for the month. But now let me talk about what to watch for between now and our next report. What to watch for? The FOMC meeting. That's the Federal Open Market Committee. Now, we economists tend to focus on what other economists are talking about, but that's the Federal Reserve, their rate hike setting committee, and that's on February. That's later on today. They'll announce no rate hike this month, but I think they're going to prepare you and me and everyone for a rate hike in Q1, and they're probably going to reaffirm their 3 rate hikes in the 2017. Look at February the 3rd, that's Friday, a wage growth. Now, if wage growth, we want to see wage growth, but if it's too strong, that's going to again push the Fed to raise rates. Now, what's too strong? 3.5% to 4% annualized is strong and going to push the Fed to raise rates more than 3 times this year. CPI, Consumer Price Index, comes out on February the 15th. That's for the month of January. That number's been, the core number that excludes food and energy, has been above 2% for 16 straight months. It's going to make it 17 when we come out this month. That is an issue. And if it moves up to 3%, I'll talk about that that's not good. But I'll talk about that when I talk about the risk now. The risk, headline inflation moves above 3%. Now, it's not there yet, but we're moving ever so closely to that 3%. And why is that a problem? Well, it's a problem for the Federal Reserve. They'll raise rates more than 3 times this year. Trade restrictions. Now, the Trump administration, they've only been in office about 2 weeks now, but they have been moving. And some of their moves we economists would agree with, some we would not. We're not in agreement with these trade restrictions, and and even immigration restrictions if they're too tight. The American economy is the most vibrant on the face of the earth. It's the most competitive, and we can compete with anybody. So we like fair trade, not necessarily free trade, but fair. I'm concerned about the trade restrictions. Strong U.S. dollar. As the Federal Reserve raises rates relative to other central banks, our dollar gets stronger. So if other central banks begin raising rates, we could see a weaker dollar. Do I expect that? No. Strong dollar, but a real strong dollar would be a real problem going forward. Now, so the outlook that I'm seeing here, based upon our surveys and other data I look at, higher inflation. Inflation is ticking up. Higher interest rates, but higher growth. Now, two of those, of course, not so good. One of them very good. So, well, that's it, folks. That was our report for the month of January, and I'll be coming back on March the 1st to report on our February results. Things are looking pretty good, maybe a little too good for some, but it was a good report, and I'll talk to you, visit with you on March the 1st. Until then, may your economic cup runneth over.